your call. Joining us in the studio tonight is Roger Montgomery from rogermontgomery.com. And we've got a caller on the line straight away. We've got Denise from Darwin, my hometown. Good evening, Denise.
Hello, how are you? Well, hello to the panel. Look, being a relatively new investor, I just wondered if the panel could just explain the difference between the ASX 100, 200, 300, etc. as against the All Ords. And my other question is, with Santos, just the return on the equity, what the panel thinks about that, and the intrinsic value to the share price. Thank you.
All right. Sorry, did you catch the first part of the question?
The first question was the difference between the All Ords and the ASX 100 and 200. Well, the ASX 100 is the biggest 100 companies, Denise. The ASX 200 is the biggest 200, and the All Ordinaries Index is about 500 companies. So that's the basic difference. I don't think there's much difference in terms of the weighting system that they use, because you'll often see the change in the indices, is not a huge, there's not a huge difference on any given day between the 200, I should say, and the All Ordinaries Index. As you get beyond 200, the weightings of those individual companies are very, very small and don't have a material impact really on the index.
Roger, interested for your comments on Santos as well.
Yeah, look, the cash flow of this business has been good because they've been paying down their debt over the last couple of years. You've seen their debt come off at Santos, so that's okay. But the return on equity is less than what you can get in a bank account. That just doesn't make sense. And as a result, so if you've got a business, let's say you've got a business with $100, right? I'll take this cup. This cup represents, so in this cup, we've got $100 of equity, and out of it is coming 3 or 4% a year. If I want to get a 10 or 15% return on my money, the only price to pay is a discount to that $100. And so that's why we're getting intrinsic values that are nowhere near the share price, because the return on equity is so much lower than the return that we want for our investing. And so in the case of Santos, my intrinsic value for this particular business is embarrassingly low. It's $3. And that's a quarter. Sorry, I think I've trumped you on most of them actually. Most of mine are a bit lower than yours, but that's okay. And so I'm looking at an intrinsic value that's a third. Now, there are some analysts who follow this company that will say, well, Roger doesn't know what he's talking about. Roger doesn't really know this business at all. The business is, the market can't be that wrong. But I remind you that, I've got an intrinsic value here for Telstra 10 years ago of $4, and it was trading at $9, and people thought Telstra was going to go to $20, $30, $100, and it hasn't. It's followed its intrinsic value. So just bear that in mind.
Next question's from Jeffrey from Sale. Good evening, Jeffrey.
Hello, can I please get the panel's view on Industrea, IDL? They're a mining services company.
Okay. Roger, does this one fall into...
it's a B2. B2. And its intrinsic value is rising at a reasonable clip. In fact, I've got intrinsic value of 42 cents, which is about where it's trading at the moment. I've got that intrinsic value, though, rising over the next few years by about 13%, which is good. I really had a close look at this company when I was thinking about mining services and looking at the entire sector, but I ended up purchasing Decmil, Matrix Composite and Engineering, and Forge, rather than this particular one, because those three companies get an A1 rating, whereas this one doesn't. This gets a B2. So I just prefer to stick to higher quality issues. That's the only difference.
Okay, there's a lot of those, a lot of businesses in that area, listed businesses. Yeah. Okay, next call on the line is Ellen from Cairns. Good evening, Ellen. What's your question for the panel?
Good evening. Mainly directed to Roger. Bluescope Steel, One Steel. Intrinsic values on these two?
Yeah. Okay. Well, I'll take Bluescope, and Mark, you take One Steel if you like.
Okay, all right.
But on Bluescope, I can answer that fairly quickly for you. Actually, it's a B3. So for me, I wouldn't invest in a B3 business. Some dilutionary capital raisings that they've had over recent years, and that's not something that I'm fond of. And the return on equity for this particular business is not as exciting as I would like. In fact, its return on equity in 2010 was just 2%, which is a third of what you can get in a bank account that's guaranteed by the government. The intrinsic value is expected to rise to 5%, maybe 8% in a couple of years' time, but still that's... there are businesses out there that generate 20, 30, 40% returns on equity that are trading to discounts to their intrinsic value. So I'd prefer to buy those than this particular one. and this is at also at a significant premium to its intrinsic value. So I've got value of about 82 cents, and it's going up admittedly to $1.49, but that's still nowhere near its current price of $2.35 or thereabouts.
The next question's from Luke. Good evening, Luke. Luke's from Port Hedland.
How you going?
G'day.
Good. What's your question tonight?
Hey, just ringing up about Mount Gibson, iron ore.
Okay. As a valuation, we might get quick. This does have earnings. It's just going into earnings. Can you give us a quick input?
Really optimistic expectations that have been built in to this. I've got an intrinsic value of $1.86, which is only slightly higher than the current price, I believe, and rising to $2 in 2012. So hopefully that helps.
Okay, then. Thank you very much, Luke. That's all we've got time for tonight. Thank you very